folks. I'm here today to teach you, or kind of guide you through some of the basic accounting principles that guide the business world. Um, let's get started. I'm the hiring manager here at Deloitte, and I'm tasked with really teaching you the basics about accounting. Most of you here are IT or receptionists, and you really have to start understanding what Deloitte is all about, and that is accounting. I went to the University of Wisconsin-Milwaukee, got my master's degree, and also my CPA license, so I am experienced in this particular field. So basically, who needs to know this information? Really, anybody that works in the business world has to know a little bit of accounting. If you don't know any accounting, you're pretty much struggling to really understand financially how your business is working. So why is this important? Well, again, you're focusing on the finances of your company. If you don't understand that, you're just kind of working every single day, not really understanding how your business is actually performing, rather just how you personally are performing. Really, what's important is how the business performs with your influence. So I'll be speaking about these four main statements. The first one being balance sheet, income statement, the statement of retained earnings, and the statement of cash flows. Fun little fact that I'll talk to you more about later is the cash flow statement is kind of used in a diabolical way on Wall Street. So we'll learn that later. So this is just a simple example of the balance sheet. This isn't the more traditional way that the balance sheet looks, actually. Usually it goes assets, liabilities, stockholders' equity. But this one is displayed this way because assets must equal liabilities and stockholders' equity. That's the basic formula of accounting. So these two numbers on the bottom must equal. Actually, the hardest part when making the balance sheet is getting those numbers to equal. So the balance sheet tells you basically what your business is all about. It tells you all the accounts you have, all the stuff you have. It's all one sheet. So as Richard Piddlecow once said in his news article, Why the Balance Sheet Matters, he said the purpose of the balance sheet is to give the company an idea of its financial condition and also about what the company owns versus what it owes. There's the liabilities or what a company owes, and the things that it owns usually consist of the stockholders' equity section with the stock and the assets it has. Banks look at a company's balance sheet not only at the information itself, but the way it's set up, because if it's a neat balance sheet, they feel like you understand what you're doing a little bit better and that you have more care in your practice. It also helps you understand the strengths and capabilities of what your company has, but also you can pinpoint weaknesses as well. So income statement is what people usually know about when they look at financial statements, because they look at that big number on the bottom, the net income. But there's two main parts that really make that income happen. And that is the net sales, which is all your revenues. Then you have to subtract discounts and stuff like that. That's something else to get into later. And then after that, you must subtract the expenses related to those sales. That's how you get your net income in the end. It's not every expense. It's only the expenses that are related to the sales. So basically, as Naomi Smith said in her article, the most important parts of an income statement, she basically says that it matters on who looks at the statement. If it's an investor looking at the statement, they'll look at specific ratios, like the earnings per share ratio, which I'll get into a little bit. But if it's the manager, they'll be looking at gross profit, the net sales, and how to really maximize those numbers. What the earnings per share is, it's at bottom of the number divided by how many shares the company has outstanding. So investors will look at that and be like, if they have a $5 per share, that's versus a $1 per share, they're going to be getting more money if they invest in the $5 per share company versus the $1 per share company. Next is the statement of retained earnings. That it really incorporates the net income And really, that's about it. You add the net income every year, less dividends because dividends comes out of retained earnings. So every year you'll get a new retained earnings balance that is carried over to the next year. Basically, it's how much equity a company has. It's the amount of money that they use every single year to reinvest in their company, to pay stockholders. It's just the money that helps them grow their business. It also shows how profitable your company is, because if that number is decreasing every year or you have a negative balance, that means you're losing money, which is not a good sign. Finally, the statement of cash flows, and this is really the fun statement to do if you're an accounting major. It's the hardest one to put together, but it's probably the most rewarding. There's really three main parts to it. Well, you don't have to get into that, but the most important one is the operating activities. That's the cash you're getting from your sales, basically. The most important cash you can get. So basically, the cash flow statement also, it tells you just how your cash is being used. It's similar to an income statement, similar, but it shows just the cash amounts. Income statements, also, they add the accounts receivable, which is the money that you're owed. That can't be included in the cash flow statement because you didn't actually receive that cash. Sherry Walters says in her article, "Don't overlook the cash flow statement." Sherry is a CPA with Shepard, Schwartz, and Harris CPA firm. She says that the most important number someone can look at is that cash from operations number, because if it's a positive amount, that means the company is generating cash from sales every single year. But if it's negative, that means they're losing money by selling products, which is never a good thing to have. So basically, a company can be both profitable, but their cash can just be terrible, because profits, like I said earlier, include accounts receivable, but that money hasn't been received yet. So you could have zero cash, but made $1 million in sales one year, but have zero cash to reinvest in your company. So stock investors will look at that and think, well, they have no money to reinvest, so why would I give them money? They'll look at the companies that actually have that strong cash coming in every single year to give them money, because they know that they'll reinvest their cash that they're receiving. So interesting fact, there's people, well, one man in particular that's called the Shark of Wall Street. He'll look at the cash flow statement and see if the numbers are declining or if they have negative balance. And what he'll do is he'll basically predict that that business will fail within the year. So that forces stockholders to sell their stocks. New investors won't even buy stocks. And when this man comes around and tells you that your cash flow statement is not looking good, your company is most likely going to fail. So to kind of reiterate some of the points, the main statements are the balance sheet, statement of retained earnings, income statement, and statement of cash flows. So what makes them important again is that if you don't understand these statements, the money in your business will not be understood. You'll just, again, continue to work without really understanding how your company is growing. And really, if you can understand this information, it opens the door to higher roles in the company, and it just really makes your daily life at the job a little better, because you actually understand how you're making the company better. And that's it.